So excited for this conversation, and like we were talking about, I have your book and I have all kinds of notes here because cool things to ask you about today, but I'm so happy. Where are you joining us from, JL?
We're on the shores of Lake Michigan.
And it's not as hot there, but what's the temperature?
It's definitely cooler than where you are. It's like living next to a big swamp cooler.
Oh, that's nice. So is it like the 90s there? I mean, is it warm?
Oh no, it's like it's in my idea perfect weather. I think the high today was 72.
Oh, wow. Okay.
It's my way, and I like it on the cool side, so that's my idea of perfect.
Okay.
And the weather's warm enough to when I'm walking along the beach to have my feet in the water.
Yeah. Well, I'm looking at the clouds and we are just about to start monsoon season. So we're crossing our fingers in Arizona that we will get water, but we haven't had any rain for a while. And it is about 105. Yesterday was 109. It is not normally this hot. Thankfully, this is hopefully just a few days because it's pretty hot.
If you get rain, it'll probably come down to steam.
Yes, exactly. It totally does. It evaporates very quickly. But I'm so happy to be here with you today and to be talking about your book. I was sharing that this copy is actually my daughter's copy because I am so excited to share this with her, and her boyfriend are going to start reading it as soon as we are done with this conversation. So just to tell you how much I appreciate your work and I love it. We've known each other for a few years now, and I love it when I go on to various blogs, communities, forums, talking about finance. And I think I'm so special talking about your book. I'm like, oh, you got to get this book. And then I notice that everyone is talking about your book already. And that's when you know that you've really achieved something, when it's on the collective mind. Did you have any idea that any of this was in your future?
So, first of all, Oprah's not talking about my book, just to be clear. So not every. I had to answer your question, though, Lisa. I had no idea. In fact, as I frequently said when I was writing it, and I don't enjoy writing. Gloria Steinem, I think, was once asked if she liked to write, and she said, no, I like having written. And that's my attitude towards it. So it took me 3 years to write this thing, mostly because I'd put it down in frustration and I'd say, this is too much work, life is too short. And my editor, who actually believed in the book much more than I did, kept dragging me back to the table, saying, no, this is important. People care. This is gonna change people's lives. And I'm like, yeah, a handful of my blog readers will probably read it, and that's it. And this is too much like work. So I'm very grateful that I finally finished it, and I'm stunned at the reception. It actually has sold more each year that it's been out than the year before. And nobody's more surprised by that than I am.
When did it first come out?
Came out in 2016.
It's so interesting.
As a matter of fact, this Friday is the book's birthday.
It is.
It is.
So 5 years?
Yeah, 5, right? That is 5 years. It'll be 5 years old. Yep.
So this
Happy
is...
birthday.
Yeah, happy birthday, Simple Path to Wealth. That's amazing. I was talking to an author of an amazing book the other day, and it came out in February of this year. And she was talking about how bummed she was that it hadn't taken off the way that she thought. And I was like, I think that these days you have to be really careful about thinking that the success of your book is based on what happens right away. What we're really wanting are to write these books that are evergreen, right? That continue to sell, that continue to make an impact in people's lives, that people will continue to return to them year after year to read them again, refresh their concepts. And I feel like that's what your book does. People come to it, I'm going to guess, and I'd love to hear what you think, but when I've suggested it and then I get feedback when people have read your book or they're starting to read your book, I see that people come to it from my world because they're realizing that they haven't focused enough time on the education for themselves about finance, and they are not sure where to start. So I recommend this book as something that's a great introduction. It's not going to overwhelm them with jargon and with all this stuff that they don't need to know. And it's a very gentle onboarding process of like, hey, you're just speaking person to person rather than financial professional to someone who, needs to learn a certain thing. But I'd love to know what you think about the person who just when they're being drawn to your work, like what's going on in their head.
Well, so I wrote this book for my daughter, and unlike me, and in spite of my best efforts, my daughter has zero interest in investing. She just doesn't care. But she's very bright, and she knows that it's something important, that getting money right in your life is critically important. As she said to me once, I just don't want to think about it all the time. And the beauty of investing is you don't have to. The simplest path is not only easier, but it's more powerful. And all you need to do is to get a couple of concepts under your belt and take a couple of simple actions, and then you can put it on autopilot and literally forget about it. And not only is that possible, it's preferable, because investing is one of the few things in life where more effort gets less better results. Most anything else we do in life, the more we practice, the better we get. Investing is the more you tinker with your investments, the worse your performance is going to be. And I've said to my daughter and in other interviews that her superpower is that she doesn't care about this stuff. She's read the book. She's got these couple of concepts down. She's got the investment strategy set up and automated. And because she doesn't care, if the market tanks, and that's the undoing of most investors because they panic and sell at the worst possible time, she's probably not even going to notice that it's gone down. Yes. The best thing she can do is do nothing for the next 20, 30, 40 years and wake up rich.
Yep. When I think about the community that is drawn to me and to my work and to the questions that come up for them, I see a lot of folks who are not necessarily, working in jobs. We've got a lot of people that are self-employed or trying to figure out how to bring more joy into their work. And that might be in the work that they do for someone else, or it might be in the work that they do for themselves and for their clients. But overall, I hear this drive for making more money or a need for making more money and kind of struggling with how to do that. And one thing in your book that you talk a lot about is saving more money. But one of the big challenges is that people aren't actually earning as much as they feel like they need to save money. Does that make sense?
It does.
The question to you is why is it so important to figure out, it's if we think of it like an equation, like what comes in is really important for what is going to go into your savings account ultimately. And if you don't have any money left over to save, you're not going to be able to do what you're talking about in the book ultimately, which is invest more. So I'm just curious if there's anything you can speak to around how important it is to get the income equation figured out so that you do have the money and just anything that's coming to you, because I know you meet a lot of people that are self-employed.
So the income part of the equation is certainly important, but when you talk about, do I have enough money to meet my needs? Well, when you start thinking in those terms, needs can be endless, right? So there is literally no amount of money that can meet the needs that humans can come up with. I like to tell the story that this is probably in the 90s. I was having lunch with a friend of mine, drawing a blank with his name offhand, but he was in the financial business, and people in that business tend to be paid very, very well. And this was around Christmas time, he just got his annual bonus, which was $800,000 for his annual bonus. And you know what we discussed at lunch? how you can't make ends meet on $800,000. And Ken was his name. And listening to Ken talk, that sounds absurd, even as I'm saying it now. I'm sure it sounds absurd to the vast majority of people listening to this. But sitting there at lunch listening to Ken go through his costs, the multiple houses, the multiple cars, private educations, $800,000 was not enough to support his lifestyle. So Ken certainly had the income part of the equation down pat, but he is never going to be financially independent. I mean, short of dramatically changing his lifestyle. On the other hand, I have a very good friend of mine from high school who's never made more than $40,000 in his life. That was a high point. He's financially independent. So it's how much you make is important, and obviously the more you make, the greater potential you have if you choose to exercise the discipline to set that money aside to invest. But it's by no means a guarantee. It's how much you keep that matters. And people say, well, I can't imagine living on $25,000 a year. So, I'm making 50 and I can't live on half my income, which is my recommendation. Well, there are lots of people out there who are in fact living on $25,000 a year or $10,000 a year. So I think people need to understand that needs and wants are very different things, and it's simply a matter of prioritizing what you want to spend your money on. For me, and from the moment I was out of college and working, and my first job paid $10,000 a year, I lived on half my income. And my happiness wasn't diminished, because money, as we all classically know, doesn't buy happiness. Lack of money buys unhappiness. But when you are saving a large amount of your money and investing, then you don't have those kinds of money worries. Mm-hmm. So yes, by all means, strive to improve your income. But understand that if you don't control your expenses, that you'll be like my buddy Ken.
Mm-hmm. Totally. And you mentioned the 4% rule, or the financial independence. Maybe you could just feature like what that is for folks who don't know, this idea of like having enough money to consider yourself independent, financially independent.
Sure. So the 4% rule is a rabbit hole we can go down in terms of its history and what have you. But and we can, if you'd like, we can do that. But I'll let you lead me there if you want.
Yeah.
The 4% rule, and I actually prefer the term guideline, because rule gets people hung up and they start worrying about whether it's 4% is the right percentage, or 3.98%, or 3.62, or whatever. It's a great 4% is a great guideline, and what it says is that you can withdraw 4% of your net worth each year, adjusted for inflation, and the research indicates that 96% of the time that will last for at least 30 years, and most often well beyond that. Another way to look at that is so if you need $40,000 a year to live on, as an example, well, 4% of $1 million is 40,000. So you need $1 million in invested assets to throw off what you want to live on. The other way to turn that around is if you say, well, I need $50,000, how much do I need to save and have invested? Well, you multiply that number by 25, and if you multiply 50 by 25, you get $1.5 million, if my math is correct. And so $1.5 million is what you need to throw off $50,000 a year. So that's the 4% guideline, and it's a very, very solid guideline.
Mm-hmm. And there's going to be a lot of people who don't get to that number, who are starting later in life, and they're not able to save that kind of money. But you're not just necessarily looking at that number. You may have Social Security, you may have a rental property, you may have the ability to rent out a room in your house. Like, there's a lot of different ways that people can get there. But I just like to say that because I think there's going to be a lot of creative retirement planning in the future, because we haven't saved enough on average when we look at the numbers across the country. People haven't saved those kind of numbers, nor do they know how to get there, especially when they're starting at 50 or even later than that, right? It's hard to get to $1 million if you don't have a clear path of how you're going to get there. But one of the things, so I know in the book you talk about different guidelines to consider, and I wanted to just explore a couple of these around, this one's
before we go there, can I address that comment before we go on?
Yeah.
So I wouldn't want anybody to get discouraged because they're coming across this information and this path later in life. It's not really a matter of something that has to be started when you're young. There's about, if you're going to save half your income, which is my recommendation, that's going to take about 12 years from zero to financial independence. Obviously, if you save more, that time shrinks. If you save less, that time expands. So if you're 50, for instance, you could be there by 62. But the important thing is that it's not just a destination. The moment you begin on this path, the moment you start saving and investing money, you're a little bit stronger than you were the day before. You're not fully financially independent, but you're a little bit stronger. It's just like working out in the gym. You know, the first day you go to the gym, you're not going to bench press 300 pounds. But then you will bench press something, and then the next day you'll be slightly stronger, or the next week you'll be slightly stronger, and you are better off for having done it the very first time, right? And the effects are cumulative. So you don't have to, I would hate for anybody to say, wow, that's just 12 years is a long time, why bother? Because, a month in, you're better off. You're in, you're better off.
And that is really helpful. And maybe you could just break that down a little more basic, because what I heard you say is there's a lot in there, because what you're earning in comparison to what you're saving. So if you're saving 50% and you're able to live on half of what you're earning, and then you take that other 50% and you invest it for 12 years, you would be able to pay the living expenses that you're at today, that 50% of your income, and that would last you about 30 years. So that's what you said, right? It'll probably last you far more than 30 years. I often say that, and this is another reason I don't like the word rule associated with the 4%, but I would never recommend anybody start withdrawing 4% of their wealth on autopilot and never look at it again, for two reasons. One, there's always the risk that things will turn bad and the wind will be in your face and you'll run out of money. That's certainly a risk, and that's based on the research is about 4% chance of that. So it's not zero. But the other side of the coin is the far more likely scenario is that while you're withdrawing that 4%, your pot of money is going to continue to grow, and in most cases in a fairly spectacular fashion. So you don't want to be living on your portfolio at 4% to say you start with $1 million, to wake up in 20 years to find that you have $10 million sitting there, where you could have enjoyed life a little more. So you want to be paying attention, obviously. And I don't know anybody who sets it on autopilot and forgets about it. Yes. And what do you say about we've seen the full spectrum of people trying to retire as early as possible in life so that they have other choices, or hit this number as early as possible. But then there's another camp where it's like, I want to enjoy my life. I don't want to feel like I'm being so constrained and restricted. So how do I enjoy today and enjoy tomorrow? Like, what do you say to that? Where it's I think people are always asking them this question, like, where's that balance to make sure that you can, what do you suggest that people do to make sure that they're not just depriving themselves so much that life feels really empty as a result of their spending?
You know, I have trouble with that concept because it's assuming that the only way you can be happy and derive satisfaction from life is spending money. And that's clearly not true. I started saving half my income from the very beginning. I have never once felt deprived or shortchanged. Of course, now I'm towards the end of my life, but I look back on it with great fondness, and there's nothing I would change. And the other thing, of course, is my income grew over the years, too. So that meant that my investing pool of money grew because that portion of the 50% grew, and also the portion I was living on it grew. I just didn't start spending the full $10,000 a year that I made in that first job. I just started spending $5,000. But when I was making 20 grand a year, then I was spending the 10. I think that this idea that there's this money I'm investing and maybe I get some benefit out of that in the future, and that's keeping me from spending it and enjoying it. You know, for me, it's just a different way of spending it. I could never conceive of anything I would rather spend my money on than my freedom. There's nothing I'd rather buy with it than my time. Now, that's me, and I realize that not everybody is like me, and if anybody listening doesn't feel that way, if they feel that a fancier car or a bigger house or whatever is more important than their freedom and time, then that's how they should make their investing choices. But I was always buying something very tangible with my investments, and it was the single most important thing to me. So when it came to spending my money, I wasn't depriving myself in the least. I was buying the most important thing first, and then everything else fit in as it could fit in.
Mm-hmm. So you weren't living this life of severe austerity. You were finding a path that brought enjoyment to you today as well.
Yeah, absolutely. I mean, I traveled widely. I didn't live in as fancy a house as my peers as I went up the corporate ladder. I didn't drive as fancy a car, but I didn't care about that stuff. Mm-hmm. On the other hand, my peers worked into their 60s and 70s. Mm-hmm. So, meanwhile, as fancy a house as my peers as I went up the corporate ladder, I didn't drive as
I pushed the wrong button on the, oh good, okay, I am seeing questions and comments coming in, so I also can't stop the sound on my phone. Technology, we were talking about that. But yeah, feel free to reach out with questions. Yes, definitely, Amy, buying the book. Questions, comments, things that are coming up for you. Would love to see those, and I'm happy to ask them to JL. I know that debt is another big one, and you and I talked about this when we first met. I mean, I feel like I have never wanted any more debt than I absolutely positively had to have, and my goal early in life was to pay off debt as quickly as I could. What's funny is now with the proper projects that we work on, I'm comfortable holding debt, but I'm looking at debt in a very different way from more of a business perspective than personal debt. It's not the personal that I carry debt on. It's things that we're investing in that allow me to make an income stream, part of our business. But and what I would say is it's one thing to have debt when you have to have debt, but it's another when you're making a choice to use debt as a leverage tool. Does that make sense to you?
Sure.
Very different, the mindset involved in that choice.
Right. I mean, what's appalling to me when it comes to debt is that as a culture, we have convinced ourselves that debt is normal and okay. Mm-hmm. And that debt is how you buy the things that we as a culture have convinced ourselves that you need to have, And it's just nonsense. To me, having debt is like being covered with leeches. You have these little bloodsuckers literally draining your life fluids from you, and my advice is take out your sharpest knife and start scraping the little suckers off. This is not normal. Carrying around debt is not normal. Of course, the more debt you carry, the more of your income doesn't get to go to you, it goes to your creditors to service that debt. It's insane, but it's normal. And it's if it's not already obvious to the people who are listening, my approach and my way of thinking is not at all the typical normal approach in our society.
Right. Well, that's what causes us to think differently, is if we're just listening to people tell us the things that are commonly assumed or done in our society, we're not going to change anything. So we have to be able to listen to other alternatives. And I feel like that's one of the reasons why the book is selling the way it is you're waking people up to the simplicity of financial management. And again, the book is Simple Path to Wealth, and over 300,000 copies sold. Just such a testament to the impact that it's making. I think that what's also fun is, I'm going to guess, if you were to pull the people that are coming to your work, a lot of them have not read financial books in the past, or if they did, they didn't find them helpful. And this is the first time that they're reading a book where it's like, I get it, I understand it, it's not that complicated, but I am going to have to change some behaviors. This is a behavior change book, right?
I've been blessed to get a lot of compliments on the book. My favorite are exactly along those lines, when they say to me, finally, I get it, I understand, this is written in a way that I can understand.
Yeah.
And because that was my goal. I'm not writing this for other financial geeks. Again, I'm writing it for my daughter as a template, who's very smart, but she's got better things to do with her life than worry about money.
Yeah.
And so those are the compliments that touch my heart most deeply.
There's a chapter in the book early on, chapter 4, how to think about money. And you have these levels. Level 1, it's not just about spending. Level 2 is consider opportunity costs. Level 3, how to think about your investments. Anything you could share about that particular chapter, how to think about money?
Well, sure. The basic idea is that when most people think about money, they think about what it can buy, right? They don't think about what it can do. They don't think about how it can be a servant to you, how it can work for you. And that's what I ask people, or what I suggest people think about, is not just what money can buy, but what money can do for you, the power of putting it to work for you so that it is making money for you. And at some point, when you have enough of it, and this is financial independence, you no longer have to trade your labor for money to meet your expenses. You have your money making money that can meet your expenses. And then a great book, The Richest Man in Babylon, talks about this. And you have a purse that is constantly overflowing, almost no matter what you spend. Several years ago, I was interviewed by a fairly well-known financial personality, and I had listened to her interviews beforehand, so I was a little bit prepared. And I noticed at the end of each interview, her final question was, if you were given $100 million, what would you do? And in the handful of interviews I listened to preparing for my own, people would list, well, I'd buy a house, and I'd buy a house for my mother, and I'd buy a Rolls Royce, and they'd talk about all the things they would buy. But she came to me and with that question, and this is after having interviewed me for an hour. And as anybody who's talked to me very long knows, I'm a proponent of investing in VTSAX, the Vanguard Total Stock Market Index Fund. He said, so, JL, if you had $100 million dropped on you, what would you do with it? How would you spend it? I said, I'd put it in VTSAX. And then I'd pull 4% a year, which would be $4 million. And she was a little stunned. She said, really? And I said, absolutely. And mentally, I'm thinking to myself, were you listening to this interview? I mean, did you hear a word or understand a word of what I've been saying? But that's what I mean by thinking about money differently. I don't think about money in terms of what it can buy. I mean, I do to a certain extent, obviously, because, we go out to dinner, we have a car, we have a beach house, and so I do think about things that it can buy. But the reason we have those things is because first and foremost, I think about how I can make it work for me.
Yeah, I get that. The way you think about money, the way you think about spending, the way you make choices, and I think this just again and again back to keep it simple. Follow these simple principles. If you stay the course, and we talked about this a year ago, right as we were heading into the pandemic, you came on my podcast, and I encourage everyone to go back and listen to that conversation. And you were saying the same thing then as you're saying now. Like, there's this consistency that you apply to your investing. So even though during the pandemic there was a big drop in stocks, you stayed the course, and then there was something else that happened where it went up, and you were talking about the fact that even when it feels like the world is falling apart, your most important job is to not sell when everything seems like it's going down. Can you just talk about how have you seen people be able to change from reactive mode to proactive mode? Have you seen people, you're this way where you can hold tight? And I hear people joke sometimes about you because they're like, not everybody's like JL, like where they don't panic, they don't get upset, they don't have emotions about this. Like, have you seen people change as a result of reading your book?
Well, yes, at least based on the reports I've gotten. But I think the thing that I would want people to understand is that the stock market goes up steadily over time. It always goes up, but it's extremely volatile, and that means that periodically it plunges. Sometimes it drops 10%, which is a correction, sometimes 20%, which is a bear market. I think in COVID it dropped 32%, which is crash territory. Of course, 08, 09, it dropped 50, 55%. What people need to understand is this is normal. If you're going to invest in the stock market and you're going to benefit from the robust long-term results that the stock market gives, and by the way, I just happened to be looking this up from 1975 until today, May of this year, when in 1975, because that's the year I began investing myself, the market's gone up over 12% a year. And that's including all the crashes we've just talked about, right? So crashes and corrections and bear markets are perfectly normal. It's like living in Arizona and not expecting hot weather. You might not like the hot weather. You might say, wow, 105 degrees is pretty terrible. 105 degrees can actually kill you if you're not careful. But nobody living in Arizona should be surprised that it gets hot. Nobody living in New England should be surprised that there are blizzards in winter. Nobody living in Florida should be surprised that there are hurricanes. Doesn't mean these things are easy to deal with. Doesn't mean they're not dangerous. But they never last. They always come and then they go and the sun comes out again. It's the same thing with market drops. So if you're going to follow the path I laid out, the first thing you have to reconcile in your own mind is that you never sell in a downturn. And you can never predict a downturn. I know the TV is filled with people claiming to. Nobody can predict the market. Nobody can time it. Nobody knows when the next crash is coming. So you just have to endure it, just like you would endure, like you are enduring the temperatures in Arizona at the moment. And as long as you tie yourself to the mast and don't let go, then you will be fine. Now, I understand that's an extraordinarily hard thing to do. And I was talking with Christy Shen, a good friend of mine. She's the author of Quit Like a Millionaire. And, I was looking at the research that says that human beings are much more concerned about loss than they are attracted to gain, right? So we are much more fearful of what we might lose than we are desirous of what we might gain. And I said to Christy, I must just be hardwired and this goes to your point about what people say about me, I guess, I must just be hardwired differently than other people, because I'm not the least bit worried about loss. I don't lose a moment of sleep over that. I am terribly bothered by the idea that I might miss out on the gains, which is why I stay invested. And Christy said to me, "No, JL, I'm sorry, you're not a special snowflake. You're wired just the same as all of us. The only difference is that you understand at a deep level in your gut that none of these crashes last and that the market always comes back." And that's probably true. If I really thought, like most people think when the COVID crash happened, that, oh my God, the world is ending, well, yeah, I'd be scared silly too. But I know in my gut the world isn't ending. I also know, by the way, that if the world were to end, then where I'm invested isn't going to matter. Mm-hmm. So with COVID, I was getting lots of feedback on social media that said, JL, your idea of the market always recovers and just stay invested through the crash, that's all great, but this time is different. Right?
Yeah.
And my response to that is, everybody thinks this time is different. Every crash there's ever been, that's been the mantra, this time is different, and it's never different. Mm-hmm. COVID was different only in the tragically, what triggered this particular crash, or back in the spring, because we're far beyond recovered from it. The only difference was that tragically this one was killing people. But in terms of market behavior, wasn't the least bit different.
Right. And that number, maybe you know it off the top of your head. So the average has been 12%, but the average investor is only getting like 4% or 5%. It's pretty low because they pull out when it goes down and they invest when it's up, and it causes this effect where the average investor gets a much lower return on their investment because of their behavior, right?
Right. I don't know what that exact number is, but you're probably pretty close to it. Warren Buffett said, I'll get this quote incorrect, but I'll be close enough for our purposes. He said something to the effect, in the last century, from 1900 to 2000, the market went up from, I think, 60 in 1900 to 11,500. I mean, just a huge gain over that century. And Buffett said, how on earth do you lose money in a market like that? And then he answers his own question, because you try to dance in and out of it. That's how you lose money in it. And by the way, it's instructive to think about that century. That enormous gain wasn't some golden age where nothing bad happened. We had 2 world wars, we had a depression, we had Vietnam and Korea and stagflation, and the Black Monday in '87, and the tech crash in 2000 and 08, 09. I mean, it was. I have a post on my blog called what did I call it? The Time Machine and the Future Value of Stocks, and the conceit of that post is that, imagine you're back in 1975 and you're sitting around, and we're in the middle of this bad economy, because the economy was bad, inflation was high, the market was doing terrible, and you all sit around and you're saying, well, I wonder if we should invest in the market for the next few decades. I wonder if that's a good idea, if we should go in this new index fund that this guy Jack Bogle created. And I say, well, in this post, as it happens, I have a time machine, and I just got back from 2015, and let me tell you what the next 40 years looks like. We're going to have this stagflation that's going to drag on until 1982, and then there's going to be this major recession as they crank up interest rates to try to bring it under control. And then we're going to have a few good years, the market's going to do well, but then you're going to have Black Monday in 1987, and it's the biggest single day, drop of 22% in the market. Anyway, I go through all the things that we know have happened. Yeah. And people say, well, around the fire, well, thank God you came back in your time machine to tell us that. There's no way we're investing in the market. So, well, except that the market outperformed everything else, and returned about 12% a year during that 40-year period.
Yeah. Well, there are three things before we finish up that I want to explore. The first is hope and faith. So what I hear when I talk to you is this eternal faith in the human being and the ability for the human being to continuously grow and expand and bring that into the ventures that we create as human beings. So these business ventures that the stock market is based on, there's a belief that it will continue to figure itself out, even in the face of these tragedies and difficulties and whatever happens. So does that make sense? Like, do you think of yourself as a hopeful person, or just curious?
Yeah, I think, well, so I think by nature I'm pretty pessimistic, and if you'd met my mother, you'd know why. But I learned a long time ago that optimism is the better and more successful path. There's a great book, I can't think of the author's name, it's a Swedish guy, he's passed away now, but I highly recommend it, called Factfulness. And we are all swimming in a sea of negativity, it seems, especially if you turn on the news. And you would think that the world has never been worse than it is today. The truth is, if you look at objective measures, and literally any objective measure you can look at, the world is far better today than it has ever been, and it continues to improve. And I think the litmus test that I would suggest to people might be sitting back saying, wait a second, that's not what I hear on my evening news, is there any time in history where you would prefer to have been born? And if you know anything about history and you think about that, your answer is going to be no. Because almost any other time in history, you would have had a shorter, poorer, much more difficult life than we have today. Doesn't mean everything's perfect today. Doesn't mean there's not room for improvement. Doesn't mean we don't have big challenges. But things have never been better. And I think that will continue. And humans, given the right environment, and I think the United States provides that tremendous opportunity, we're going to continue to prosper. Now, if we do something stupid and destroy our capitalist system in the process, then all bets are off. But as long as we live in a capitalist country that rewards work and effort, and ingenuity and creativity, which is the world that we've created and we live in, then I have great faith in the future.
The other two things I wanted to mention was inflation, and I know you recently wrote a great post about crypto, and I'd love to talk about crypto for a minute. I actually signed up with your link after your email about crypto. I was like, it's time. I just want to do this, and I would just call it playing. So that's my take on it right now. But inflation is something that is definitely happening. You go to the grocery store, you see things that feel like they've doubled in cost in like a very short amount of time. I do the grocery shopping, whether it be Sam's Club, Costco, or the grocery store. I'm noticing it everywhere. Curious about your take on inflation, and also maybe just reinforcing the idea that part of the reason investing in this stock market is the tie to inflation, of how it can help people kind of prepare them for inflation, I guess. Prepare their assets for inflation.
Right. So just real quickly on cryptocurrency, to be clear, I'm not invested in any cryptos.
Yes.
I don't recommend being invested in it. The two most recent posts on my blog, the most recent one was a guest post from a fellow who is invested. He makes the positive case for it.
Yeah. The
one before that is my take on it, which is much more conservative, I guess. So I am.
Got it.
Maybe if Bitcoin drops to 10,000 or something, maybe I'll be interested at that point. But I'm not. I'm not a crypto investor at this point. Inflation, I think there's no question that inflation is coming. It occurred to me the other day, I have memories of the 70s because that's when I was in my 20s. I came out of college in 72, so I have very clear memories of inflation, but I'm an old guy. And to have any clear memories of inflation, you got to be older than 60, maybe even older than 65. So most adults most people in this country have never experienced inflation, and it's pretty ugly. And I think it's coming. I am appalled at the amount of money that our government is spending and the amount of debt that we are running up. And I just don't see any way that that's not going to be inflationary. And I know there's modern monetary theory that makes the case that it doesn't matter, but I think that's wishful thinking. That's my take on that. So I think inflation is coming. Stocks are my inflation hedge. Bonds are a deflation hedge, which is why I hold bonds. And deflation, until recently, has been the bigger risk. But stocks are an inflation hedge because when you own stocks, when you own BTSAX, you own a piece of every publicly traded company in the United States. And those companies have tangible assets. They have buildings and products, and they sell things, and they can raise the price of them. And so those are inflation hedges. As prices rise, the value of those companies will tend to rise as well. Now, that's assuming we don't get into some really ugly hyperinflation, and there's really nothing that survives hyperinflation. But I don't see that on the horizon. But so I think stocks are a good inflation hedge, and they're a good place to be. Now, initially, stocks can take a hit as inflation rises because the Fed will raise interest rates, and as interest rates go up, then other assets like bonds become relatively more attractive to stocks, so they tend to siphon money away. But over time, stocks, because basically you're buying those tangible companies, are a good inflation hedge.
Yeah. Part of what my husband and I are constantly looking at is real estate, and real estate has been going through a period of pretty extreme inflation in the pricing structures, especially in certain markets throughout the country. And right. It is interesting because you also have the combination, and part of the reason I think it's fueling it is the low interest rates combined with a whole generation of people buying homes that had really been on the fence about whether or not they wanted to buy homes. And so now you find yourself in this country with a shortage of homes for the number of people that are wanting to have homes, especially in certain markets. And so that's been one of our ways of protecting ourselves, is by having real estate, because like you and I talked about, we've built more of our wealth through real estate versus investing, because I would count myself as one of those more emotional investors, and I like to be able to have the tangibility of the physical property. We've done fine, nobody needs to worry about us, but it's part of the reason I love talking to you, because you bring in this other perspective. What I also want to share with you is, I didn't realize that was a guest post about crypto, because I did read both of your posts and I thought, wait a minute, this is like different than what he was writing about last time. So now the pieces are coming together. But I want to share something with you as feedback, because the light bulb went on the other day for me, in that I went ahead, and I mean, we're not talking about a lot of money here. We're talking about like $50 investments in cryptocurrency, like super simple things. But what I realized was happening for me now 2 or 3 weeks into investing in crypto is because I do have so much unsteadiness with the stock market in general, not as comfortable as you are. It's actually teaching me how to have fun with investing, which I actually have never thought of investing as a fun thing, because I go on to the crypto, after I've invested, $100, and I see that it's gone from $33,000 to $39,000, and I was like, well, this is really fun. But because it's such a low amount of money, it doesn't really matter. I made all of $4 or something silly. But what I just want to give you feedback on is that for some of us who do struggle with the ups and downs, crypto can be a really good teaching around just learning about volatility and uncertainty and being comfortable with the uncertainty without having it be a lot of money. Because for me, I have a lot of money that I've invested in the stock market. That's not easy for me to learn how to get over my fears. Crypto seems to be really, really fun right now. So I just want to give you that feedback that we're all on our journey.
Wow. So I would have, there are two things about what you've just said that make me uncomfortable.
Okay.
Number one is owning your crypto is teaching you to watch it all the time. And as we said earlier, the best thing you can do with your investments is to set them on autopilot and forget about them.
Yeah.
Because the more you watch them, the more inclined you are to tinker with them.
Yeah.
So that's concern number one I have. Concern number two I have is figure out other ways to have fun. Having fun with your investing money is the wrong way to have fun. I always cringe a little bit when people say, well, your idea of investing in low-cost index funds and holding them forever, that's not fun. Buying and selling stocks and that's fun. And it's like, well, yeah, I do other things for fun.
Oh, totally.
I don't invest for fun. I invest to make money.
Yeah, right? No, I am definitely not checking it on.
So the way you would invest to make money is you invest in the right thing, which is low-cost index funds like VTSAX.
Yeah.
Hold it forever, you forget about it, and then you take the money that's making for you and you go out and have fun with that.
Oh yeah, totally. No, we're on the same page about that. I think it's really hard for you, quite frankly, to understand where I'm coming from in what I'm learning and where I'm growing, because we couldn't be further apart from each other in that stamina when it comes to the stock market going up and down. Like I think it's fascinating because it's true. We have had very different backgrounds where you didn't have kind of the money story that I did, where you have money and then you have nothing. And it happened so many times when I was young that the stock market plays off of the worst fears that I have in life. And so when I say I'm learning how to be comfortable with volatility, that's actually a big deal for me based on my money story. Does that make sense?
It makes sense. You're a hiker, right?
Yes.
Yeah, you live in a beautiful part of the country. You're a hiker. I know that from our friendship. So I'm sure at some point or another you have hiked up the side of a hill or a mountain where the dirt was loose, right? So you're kind of trying to go up, but you take a step and you slip down a little bit, and then you take a step and you slip down a little bit, but slowly but surely you make it to the top of the mountain. But every other step, or maybe even each step, you slip back a little bit. That's the stock market. It's not an easy walk up where every step advances you.
Yes.
It's a step slide, step slide, step slide. But in aggregate, you're getting higher and higher up the hill.
Totally. And I do not by any stretch believe that crypto is the way to go. I want to be crystal clear. And I get asked about it so much. And I will also say there are a lot of people out there hyping it up, talking about how you should be putting all your money in it. Like people that, especially in the spiritual world, where there's a thought that we need to get off of the existing system and go create a completely different currency system because the one that we have now is so corrupt and manipulated. So I dance in both of these worlds, and I feel like a hypocrite to talk about things that I don't actually have any personal experience with. And so it's been an interesting journey to just be willing to kind of look at it and be able to speak from personal experience, because I don't speak about anything unless I have some personal experience with it.
Well, I don't have any personal experience with it, and I have 2 posts on the blog, so I guess I talk without experience. So
But it's good. This is good for us to talk about, because I don't think people are talking about it enough. When you hear just like, oh, crypto this, crypto that, I'm like, wow, this is a wild conversation, because I feel like it isn't. As we know, one of the big issues with crypto is typically when you're buying an asset, you are buying it for the long-term appreciation. You are not buying it because it's going to be at 10,000 one day and 70,000 another day. Like, that is not a stable asset to invest in. I just want to make sure that, I mean, that's an extreme, but you know, do you want to say anything to that? I mean, because you do have an opinion on it.
Sure. I mean, I think crypto in that sense is like gold, right? So there is no intrinsic value. Though both gold and Bitcoin, let's just pick one crypto, both those are valued at whatever people are willing to pay for them right now. When you own stocks, you own parts of tangible businesses. And those tangible businesses, they're not all going to be successful, but they are working to be successful. They are working to create services and products that generate money. They can earn money. And based on that earning potential, there's speculation in stocks, certainly, but that underlying earning potential is a tangible value. I liken it, when it comes to stocks in my book and on my blog, to a glass of beer, right? So there is certainly trading. There's certainly speculation in stocks. That's the foam on the beer, but there's also beer under there. That's what, as long-term investors, we're in it for the beer. With crypto and gold, it's all foam. So it's all what people think it happens to be worth at the moment, which is why crypto is so extraordinarily volatile at the moment. Mm-hmm. So will you get lucky and buy it at a certain point where a year or two or a day or two in some cases is going to be worth considerably more? Sure. But the corollary of volatility is it also goes down.
Yes, totally. Thank you for talking about that with me. I do appreciate it. And the book is The Simple Path to Wealth. You can get it on Amazon. You can go and get signed up for your blog. How do they get on your email list? Because you don't do it all the time, but when you send something out, it's very, very interesting.
Well, so I mean, if you go to the blog, which is jlcollinsnh.com, then you can subscribe to the blog. And the only emails I send out are when I do a new post on the blog. It goes out to people who have subscribed to the blog. And I'm also, you can find me on Twitter and Facebook. Again, JL Collins NH will get you there on both those things.
That's
but
great.
Yeah, I don't have an email list that I mail to other than when I do posts on the blog.
Okay, that makes sense. And we're definitely talking this summer in the community a lot about how can we know the number that we're going to need for retirement? How can we become better prepared? How can we start saving more? How can we learn about spending less and making better choices about spending? I mean, these are all things that we touched upon today that you're going to be learning about and getting reinforced when you read the book. So definitely want to check it out, because this work, what JL is talking about, completely supports the things that I want you to be thinking about as you build wealth and you take good care of yourself. And just listen to this conversation a few times, because you did make it really simple for folks to understand that in 12 years, if you can set yourself up into a good situation where you're saving half of the money coming in, meaning the half of the money coming in can support you. You do that for 12 years, investing in the tools and the tips that are shared in the book, then you could be in a very good position of retirement. So it's not like some 30 years away. Like, you can do this in a much faster way than the mind probably is telling you. Anything you want to add to that?
Yeah, and what we've already said, it's not just the destination, it's the journey. So in year one, you're stronger than you were at the beginning. Year two, stronger still. And then you mentioned that there are also other sources of income that come into play, like Social Security. And the other thing I'll make note of is there are a lot of people who follow this path who are in the financial independence community who achieve financial independence at an early age and they quote unquote retire. But I've yet to meet one who just sat on a beach at that point. I mean, these are smart, ambitious people, and the idea that you're going to retire, even if you retire at a traditional age and never do anything again, is probably highly unlikely. And there's also a high chance that whatever you choose to do in retirement might just wind up throwing some money off. And so I've at these Chautauquas we have, when I do one-on-one counseling with people, I'll get people, for instance, who will say something like, I need to spend I need $50,000 a year to meet my needs, and I have $1 million, which I know would support $40,000 a year. That's a $10,000 a year gap. And I'm in this soul-crushing job. I can't, it's killing me, but I can't imagine hanging on to get that extra $500,000 that I need. And I say, man, if I'm in a soul-crushing job, I'm out of there. Mm-hmm. And, if with $1 million you need $50,000, that's a 5% withdrawal rate. You know what? If you look at the Trinity study, which is where the 4% rule comes from, 5% succeeds 86% of the time. I am absolutely going to take that gamble. Now, I'm probably also going to turn around and say, now that I'm out of my soul-crushing job, is there something I can do that's fun that might throw off the extra 10 grand a year that I need? Mm. And I doubt very seriously that the kind of people who can get to that point are not going to be able to figure out something that they can do that is not soul-crushing, that'll throw off $10,000 a year. So there's a lot of flexibility in this. That's why I don't like 4% rule. I like 4% guideline. And by the same token, the other side of that coin is that I've had people who have said to me, I need $1 million or I need $50,000 a year to live on, and I'm at $1.5 million, maybe I'm even at $2 million, but I love my job. Do I have to quit? No. No. Just because you're financially independent doesn't mean you have to quit your job. It means you can do whatever you want to do. And if you love your job, by all means, keep doing it. And, the more money you add to the pot, the stronger position you're in. So it's not, that's why I say it's not a finish line. Mm-hmm. And you can have a lot of freedom without getting to that 4% finish line rule, mm-hmm. which is why I don't like that word rule. So, every step makes you stronger.
So true. Gloria said she's totally in. The title is The Simple Path to Wealth. I'm just looking at the notes coming in. I'm so happy. There's several people saying they're going to get the book. And this abundance mindset is what I feel like you're living by, that you're modeling, that you're encouraging, the idea that it's possible, having choices, putting yourself in a position of having choices so that you can decide what you want. Even for me recently, I'll just share, we reached this new level of wealth, and I went through a several month period where it was like, wait a minute, I realized that I want more free time and I don't want to work so much and I don't need to financially. And what I found on the other side of that exploration is that there were ways that I could reconfigure my business to put more on the people that work with me and pay them more. And I might make less, but it was okay because I'm helping other people and I'm continuing to serve my community. But it was that abundance thinking that needed to go off in my head about what is possible, not coming from it, with this mind of scarcity, like, oh, if it's not working for me because I'm working too much, then I just shut it down. It's like, no, the thing that money does is it opens up possibilities and opportunities that I wouldn't have maybe had available to me before the business was profitable in that way.
I agree with all of that, and I mentioned my friend Christy Shen, and her book is Quit Like a Millionaire, so I would recommend people add that to their list.
Yeah.
But I heard her giving an interview on a different podcast just yesterday. I was listening to this, and she was talking about her story and her husband Bryce, who they wrote the book together, and she said, when we were trying, before we were financially independent, we had ambition. They're engineers by trade, and we wanted to be authors, and we were trying so hard, and nobody would pay any attention to us. We couldn't get anybody to listen to us. And then we became millionaires, and we quit our job, and we just started giving all of this stuff away. And the next thing we know, we had publishers coming to us and asking, would you do a book? And the idea that, the moment we started giving, this is Christy talking now, the moment we just started giving this stuff away, suddenly all the things that we were trying to grab and failing were handed to us.
Wow.
And yeah, I think that's a very, very powerful thing. If I can recommend two other books that our listeners add to their list. One I alluded to already was The Richest Man in Babylon.
Yep.
My only hesitation about recommending that book is it's very short, and it's simple parables, and it's so simple that it's easy to lose sight of how profound the lessons are. Mm-hmm. So I recommend that people take a lesson from your book and your book title and read that book mindfully. Of course, your book is one that I love and recommend. And then the other one that I just finished is Morgan Housel's book, The Psychology of Money, which a lot of people recommended to me, and it did not disappoint.
Ooh, I have it on my list, so I have not read it.
It's interesting. I don't agree with everything that he has to say, but to me, that's not the lit. I don't expect or even want to agree with everything that an author says in a book I read. What I expect and want is that their ideas are laid out clearly and rationally and have some thought behind them. And all of his, including the ones I disagree with, all of them do. So I highly recommend that book as well.
That's great. And I will, Gloria, share the books he's recommending. I'll put them with the authors and everything in the show notes. That's awesome. I have Christy's book, so that's great too. So I love it. I love having you visit us.
In full disclosure, by the way, I wrote the foreword to Christy's book. So.
Oh, okay. That's awesome. I did not even realize that, but I know you're friends, so that's cool. And we'll make sure that everybody gets those links and go get the book and share what takeaways and learning you're getting as you read it. I've been hosting a group of folks with a mortgage company, and I recommended they get it. And today we had a meeting, and everyone was commenting about the things that they were getting from the book and how it was just expanding the way that they thought about money. So lots of testimonials about your work, and I'm so happy that we're here connected.
That's awesome to hear. I'm so happy you invited me.
Thank you everyone for watching, for listening. We're so happy that you visited. Bye.